Right now, the Chinese are buying up gold by the pallet, preparing for something big in the global currency markets. Today, a story completely missed by the media and even gold analysts is China's 7,000-year-old strategy to acquire gold for pennies on the dollar. The financial press has barely scratched the surface of China's gold hoard. The real secret to their gold accumulation will one day shock the world. The Chinese aren't the only ones using this strategy. So are some of the wealthiest investors on Earth, accelerating their gold accumulation with one of the oldest businesses known to mankind. Learn more about China's real gold accumulation strategy at futuremoneytrends.com/China strategy. Greetings and thank you for joining us at futuremoneytrends.com. I have a special guest for us today. If you're feeling a little uneasy about the markets right now, if you're starting to get a little bearish or concerned about another 2008 crisis, my guest today is going to take you right over the edge, literally. He's the author of Demographic Cliff, Harry Dent, editor of the free newsletter, Economy and Markets. Harry, thank you so much for being on the show.
Thank you.
I want to start by letting our audience know that by visiting harrydent.com, you can actually receive a free copy of his recent book, The Demographic Cliff. Just chip in for shipping and handling. Okay, so everybody is interested in the markets right now. Even if you're not a participant in the markets, I'm getting texts and messages from all sorts of people in my life. So Harry, I'd really like to talk about the near term. What's happening right now? How does it fall in line with your demographics and your forecasts and projections? And is this a 10% correction, which the mainstream media is really pushing? Or is this something larger and grander in the works?
We've been predicting for decades that by 2008, we'd be in a slowing economy. And that's why we have endless QE up until recently and 2% growth at best, in response to that. Baby boomers are done, and they're the largest generation in history, and there aren't really the next generation for the first time in history will only be about the same size or a bit smaller. So you've got a dilemma that we're already seeing in Japan. Their baby boom peaked back between 1990 and 96, as we predicted. We were the only people that saw the collapse of Japan when they looked like they could do no wrong. And they're still down. Real estate's still down, 25 years later, and their economy is still very, very sluggish, despite 3 times the quantitative easing that we've done, because they have older people dying now faster than younger people are coming along and buying homes and spending money. So this is a big deal. And once in a lifetime, we get what I call a bubble burst, a credit bubble and financial asset bubble. It bursts like the Roaring '20s bursting in the 1930s. And that's what we call the winter season. That's when you get deflation in prices, deleveraging of bubbles. And the problem is when that happens, everything goes down together. Stocks, commodities, real estate, you name it, everything but the safest bonds. And in this case, like in 2008, the reserve currency, the US dollar, goes up. So this is not a correction. And we've been warning about this. We've been telling our subscribers, get out ahead of this bubble. Don't wait until it's obvious like now, because the markets get very volatile. And the first wave down in most major bubbles in history tends to be 30-40% or more. The tech bubble was down in the first 2.5 months, the NASDAQ, 40%. The 1929, when that bubble finally first burst in the Dow, 46% in the first 2.5 months. And we just saw China demonstrate this exactly. China bubble burst. We were warning about it. It burst 35% in the first 3 weeks. And 2 months later, it's still going down. It's down 42% before yesterday's bounce. So this is what happens. So we telling people, use times like this. The markets are bouncing. They might bounce a little more. It gets harder to predict. But use bounces in the market to get safe, to protect your capital. We see the markets on and off being down into 2020 to 22 before our demographic trends turn up. Again, we've been saying that forever. And again, I think the most dangerous time is the next month and a half, because mid-August to mid-October is the crash season annually. When you do see major crashes, that's the time you're most likely to see the strongest down moves. And our cycles point down into late 2016, early 2017. So we think we're going to have another 2008-like crash. It's just going to be bigger now that we've kicked the can down the road with all this artificial stimulus, and we've created a whole nother bubble. All this money, $4.5 trillion from the central bank, the Federal Reserve, and then 10 to 12 trillion around the world. All of this has just gone into speculation. Companies, major companies, have been using free money, near free money, to buy their own stock to make their earnings per share look better. Governments around the world are using free money created out of nowhere to buy their own bonds and suppress interest rates and make money free. I mean, a 2-year treasury with average 2% inflation is 2%. That means the money's free, adjusted for inflation. Short-term rates, the Fed is set now for 6.5 years, at 0. Money is free. When money is free, it will be abused every time.
Now, is that inflationary by definition, the free money? However, my assumption is that the deflation, the natural forces of deflation of just economic science, is too overwhelming for the Fed right now.
Yeah, that's what people need to understand. All the gold bugs, I have to argue with them all the time. They're smart enough to know we got a problem, but they don't understand what happens when a debt bubble deleverages because they don't study history close enough. Money that's been created, all this money printing, it hasn't gone into lending capacity because consumers already overborrowed in the boom. And businesses already overexpanded in the boom. And China has overexpanded 10, 12 years in advance. So you've got all this excess debt, excess capacity. So the money ends up going into speculation. All this money goes into the economy, and hedge funds leverage it up 20 to 30 times. And all it does is create bubbles. So we're not getting consumer price inflation, which we normally would. If you created all this money in normal times, you would tend to get consumer inflation because it would go into the banking system and it would be, money would be lent out and it would create more money chasing goods. It's going into financial asset speculation. So all we get out of this is bubbles. And bubbles do one thing every time in history. And every time I get on TV or something and I say the Dow could go to 5,800 to 6,000 in the next year and a half, and it's a bubble, it's going to burst, and people say, oh, it's not a bubble because of this, not a bubble because of that. I'm like, this is a bubble. Look at it compared to the 1990s. The Dow and S&P look almost exactly like it did back then. It's a bubble, and it's going to burst. Bubbles only burst. And if anybody can find me a stock market or a commodity market or gold or anything else that went up exponentially in 5 or 6 years and didn't burst, I'd like to see it because I've studied all the history. It doesn't happen. So this is a bubble. It's going to burst. That's why investors have to get out of the way. This is not a buy and the hold. This is not a buy the dips market anymore. You've got to protect your gains in real estate and in stocks and anything other investments you have before everything crashes, because the market and the economy want to deleverage. They want to get rid of debt. Debt's now 230 trillion around the world. 100 trillion that's going to disappear like it did in the 1930s. Stocks need to get back down to earth so that the young investors can invest again. You have no chance of making money buying stocks at these high levels. The best models show you'd be lucky to make -1 to -3% a year over the next 10 years, given how highly valued stocks are. So we need this whole thing to delever. It's kind of like a financial detox, and it's painful. And all you have to do is look at the 1930s to see how painful it can be. But if you do get out of the way, and if you are in cash and have cash flow investments, everything will work to your advantage. You're going to be able to buy financial assets, real estate, stocks, companies, gold, anything at 10, 20 cents on the dollar in the next several years.
Now, in situations like where commodities have just been in a severe bear market for the past 4 years, a lot of these commodities, they're trading for less than the cost to produce them. Let's mention gold specifically, platinum. I was looking at like a platinum palladium mine. They only pay these guys like $450 a month, and they can't generate the cost of capital to produce these commodities. Does that play in at all, or is it just, again, it doesn't matter about supply and price discovery right now because there's a wave of deflation, and a lot of the demand that is currently priced into the commodities was fake anyway because it came from places like China and the U.S.
It's still supply and demand because businesses around the world, not just us, overexpanded in a boom that looked like it would go on forever and was highly leveraged by debt growing at 2.6 times GDP in the United States alone. And